even after these crazy moves, the bond market is still telling a story of this perfect soft landing where the Fed is easing because they can. There's about 100 basis points of eases priced in for this year and another 100 for next year. Even this time next year, we're still at around 3.5% compared to the Fed's own definition of neutral, which is their long-term dot at 2.5%. Rates are still restrictive. And even 2 years from now, the trough of the Fed funds curve is still 3%. So what the market's telling you is the Fed did such an amazing job that inflation has come down. Rates will never even really need to get to neutral, let alone accommodative. And we at TCW couldn't disagree more with that narrative, and that's why we're long duration. We think the Fed is going to be easing because they have to, because the economy is weakening, lags are longer. We still haven't even hit markets and the economy with the full effect of that rate hike. So we have a ways to go. And on top of that, lags are going to be long on the way down too. So the Fed easing rates a quick 100 basis points isn't really going to help the market that much if it doesn't feel it for quite some time after the move.
Okay, so you're long duration and you're happy with that position. A number of people are saying, look, on the backup of yields, you want to pick up and reload duration. It mightn't be as rich, but you want to take it on board. That's PIMCO. Good afternoon, JPMorgan. Jay, how are you doing? Now, listen, you're going for 50-50 back-to-back cuts, and I checked it with you in the break. I was quite surprised. That is a bold call. 100 basis points within such a short space of time says harder landing than we currently think, to me.
I think our call is, not too different from Jamie's, but I think there's some nuance to it, that we are looking for aggressive eases in both September and November. But I think it's because there's been a constellation of weakness in the labor market data that we've seen for the last couple of weeks, which was punctuated with employment last week. But also because the Fed says now that it's attentive to both sides of its dual mandate and not just the inflation mandate. So from that perspective, given what we've seen in labor markets and given what the Fed has told us, we think this makes the case for the Fed to get back to neutral with haste. Because as Jamie said, there are long and variable lags to monetary policy. It's evident that policy is restrictive right now, and we think this means the Fed needs to get to a less restrictive place and with some relative haste. So we're not necessarily in the hard landing camp. We just think the case for policy to remain restrictive here is losing steam rather quickly, and we think the funds rate will be back at 3% by the middle of next year.